We'll now look at gross income. All the money, all the income that you've earned during the year which goes into your form 1040. Uncle Sam wants to know all about it. As we discussed, your gross income would include a bunch of schedules and individual line items which we summarize using our mnemonic Sir You Owe. It's like Uncle Sam telling you, Sir, you owe. You've earned all this gross income, now you owe taxes to Uncle Sam. So when we talk about gross income, the big item, the most common item, wages and salaries. So it's like every month you're working really hard for your employer and you get a paycheck at the end of the month. So that's 12 paychecks for the year on your form 1040. Now, end of the year, your employer gives you a form W2. On that form W2, which your employer gives to you at the end of the year, the employer lists down all the wages, salaries, commissions, tips, everything that you've earned as part of your employment during the year. The employer on the W2 also includes taxes that the employer withheld from your paycheck and remitted directly to Uncle Sam. So you're going to have your compensation income plus taxes withheld by your employer on your W2, wages and salaries. Next, we have Schedule B. So let's say you have some extra money, you invested the extra money into bonds and stocks. From bonds, you get interest income. From stocks, you get dividend income. All of that goes on to your Schedule B. So Schedule B has a section for interest, a section for dividends. You put all of that, total that out, and the total then flows into your form 1040. Next, you got Schedule C. You're running a sole proprietorship business, working really hard. Your sole proprietorship business has revenues and then has expenses. So revenues less expenses, that's your profit from your business. All of that is computed on Schedule C. The final profit, the final bottom line comes on to 1040 included in gross income. Next, we got Schedule D. So Schedule D is capital gains and losses. So let's say you have a 100,000 house which you've now sold for $400,000. That's 300,000 capital gains on Schedule D. Or let's say you sold some stocks or some bonds and you've made gain or loss on sale. All of that is Schedule D, which is capital gains as well as losses. Next, we've got Schedule E, which includes supplemental income. So let's talk about your salary income, your business income. You work really hard for that. You earn it. Schedule E is typically income which you don't really work so hard for right now. You may have worked hard in the past. Let's say you worked hard in the past, bought a property, now put it out on rent. Now you're getting rental income for that property. That's passive income for you today. Or let's say you wrote a book or developed an intellectual property. Now today you're getting royalty income, passive income on Schedule E. Let's say you're a partner in a partnership or a shareholder in a S corporation or a beneficiary of a trust. All of that income from flow through entities, income from partnership flowing into Schedule E into your 1040. Income from S corporation flowing in, income from estates and trusts flowing in. So we'll talk about all of that. So all that flow through entity income, that's again Schedule E. So you're going to put all of that on your Schedule E. Schedule E is going to have your rental income, royalty income, income from flow through entities, total it out, and that total goes on to your 1040. Let's say you run a farm, you grow crops. All of that is going to be there on Schedule F. So on Schedule F, you're going to have your revenues from your farm, your expenses on your farm, the net profit from the farm, That's going to be farm income flowing into 1040. So guys, we have a bunch of schedules, as we said, schedule B, C, D, E, F, and then our mnemonic for this individual line items. So here you have schedules for these items. For the individual line items, you don't do schedules. They are individual line items on your 1040 or additional income items on your schedule 1. So they are all individual line items, and our mnemonic once again is SIRUO. So SIRU and OWE. So the S of SIR is Social Security Benefits. So let's say you've worked really hard in your lifetime and now you're retired. When you work really hard in your lifetime, you earn salaries, you paid payroll taxes to Uncle Sam. Now you're retired, Uncle Sam is giving you Social Security benefits. That's the S of SIR. Now that you're retired, your employer is giving you pensions. During your lifetime, you put aside money into your individual retirement accounts. Now you're getting the distributions as retired individual, IRAs, pensions and annuities. So these are typically income items for retired folks. The R of SIR is refunds of state taxes. So we'll talk about that. Let's say last year you claimed a deduction for state taxes on Schedule A as itemized deduction. This year you're getting a refund back. So you don't really need to go back last year and change that number. So this year that refund is an income item. We'll talk about this. So let's say you couldn't find yourself a job. Uncle Sam's there to take care of you. Uncle Sam is going to give you unemployment compensation. But the funny part, that unemployment compensation is also taxable on your 1040. So SIRUO, the O of O is other income. So let's say you went to Vegas, and as a mathematical genius that you already are, you've won $500,000 in gambling winnings. $500,000 other income on your 1040. Uncle Sam wants to get taxes on all the money that you've earned from Vegas. The W of O is wages and salaries. Because wages and salaries is such a big item, I've put that up separately right there on the top. But that's actually the W of my SIRUO mnemonic. And the E is earnings from foreign sources. So I'll talk about this. Form 1040 for US citizens, US residents is their worldwide income. So the gross income here is not just US income, it's US and foreign income, all of that put together. I know, this sounds worrisome because the US citizen who's having income outside the US is also going to be paying taxes outside the US. So for all the foreign taxes paid, we'll talk about how the taxpayer gets foreign tax credits. Remember, my mnemonic was ASDLs equals foreign business winner. The foreign here is a foreign tax credit. So again, we'll cover all of this one by one. But before we get started, let me talk to you about a few baskets of income. So we'll put all this income into 4 baskets. So let's look at the 4 baskets on the other side of my board. So what we're doing is all this gross income, I'm going to classify into any one of the 4 baskets. So let's say when we talk about ordinary income, that's the income you've worked really hard for, earned it. Let's say your wages income, wage and salary, W2 income, your Schedule C, your business income that you worked really hard for, or you've run a farm, and Schedule F, farm income. Also, most of the income items on SIRUO would also get into ordinary income. So let me put that here for now. SIRUO, most of it. Now, if you have a portfolio of bonds and stocks, you get interest income, dividend income. All of that goes into Schedule B. So Schedule B is predominantly your portfolio income. So let me put that here. Schedule B, portfolio income. Schedule E, we said supplemental income or passive income, right? I mean, you have a house property, now you're getting rent from it. You got an intellectual property, you're getting royalty income. You have partnerships or S corps where you've invested in, now you're getting income from all of that. So all of that is passive income, the third basket, Schedule E. And if you have capital gains, we know that is Schedule D. So Schedule D comes in here. Now, the reason I have classified all these gross income items into 4 baskets is to help you understand certain limitations. So let us say in basket number 1, let's say you're running your business, Schedule C, you have a loss. We call that a net operating loss. So if you have a loss from your business, the question is, can you take the loss out of this basket and deduct against income from other baskets? And the answer to that is there are limitations, which means that if you have a net operating loss in your basket number 1, you can deduct it against income that you have from basket number 3. But you cannot deduct the net operating loss from portfolio income or capital gains. So let us say you are having limitations to deduction of this net operating loss. So you have a net operating loss and let's say you have no passive income. In that case, what you're allowed to do is carry forward that net operating loss indefinitely and deduct it against future income or future gains, let's say from this basket. So you can carry forward your net operating loss, but you cannot deduct net operating loss from basket 2 or basket 4. Let's talk about limitations in basket number 2. So you have portfolio income, but what you've done is you've actually borrowed money to invest money. Now on the money that you've borrowed, you have to pay interest expense. We call that an investment interest expense. Now the rule is you can deduct investment interest expense only to the tune of the investment income that you make here. And we'll talk about investment interest expense, which is deductible as itemized deductions on Schedule A. But the point is, you can deduct this only to the extent of portfolio income. Now, if your investment interest expense for this year is in excess of your investment income, you can carry it forward and deduct against future investment income, future portfolio income. But you cannot deduct this from other baskets. Right? So, again, you can carry it forward. Let's talk about the limitation as basket 3, passive income. Let's say you have a house property, but net this year you have a loss from that passive activity. We call it a passive activity loss. If you have a passive activity loss, you cannot take that passive activity loss out of this basket and deduct against other baskets. If you have these passive activity loss, you are still allowed to carry forward those losses and deduct it against future passive income. So again, carry forward. Now let's talk about the limitation in basket 4, capital gains. Let's say this year, instead of capital gains, you actually had a capital loss. So let's say you had a capital loss of $8,000. Now, individuals are allowed to deduct up to $3,000. So you could take up to $3,000 of capital losses and deduct against other baskets. Let's say deduct against ordinary income. But beyond that, beyond $3,000, you will have to carry it forward. So let's say if you have $8,000 of capital losses, $3,000 deduct this year. Remaining $5,000, carry it forward. Let's say next year you had no capital gains, no capital losses, nothing. Next year again you can take $3,000 out from the basket. And for the third year, the year after next, you're going to have the remaining $2,000. So guys, The reason why we have classified income into these four baskets is to help you understand the limitations if we have losses or if we have certain expenses which are more than income. So with this, let's get to the book, look at gross income, look at baskets, the four baskets, and then we'll come back and we'll start with wages and salaries, your W2 income. On page 23, we're looking at a few baskets of income. The first one, highlight ordinary income. And right there, for example, salary. Next, highlight portfolio income. And right there, investment income. And for the portfolio income basket, note that highlight investment interest expense on Schedule A itemized deduction is limited to the net investment income. Next, highlight passive income. For example, write rental income. And the limitation here is highlight that net passive loss is not deductible. May be carry forward indefinitely until offset by passive income. And then we've got highlight the capital gains and losses basket. For example, write sale of property, where we have a limitation for net capital loss. Highlight net capital loss is deductible only at $3,000 per year. May of course carry forward indefinitely. We continue to look at gross income on Form 1040, and your line number 1 for gross income is wages and salary income. So let's talk about that in a lot of detail. So all the wages, salaries, commissions, tips that you receive from your employer during the year is included on the Form W2 which your employer gives to you at the end of the year. That Form W2 also includes mention of all the withheld taxes which your employer withheld from your paycheck and remitted to Uncle Sam. Now, talking about tips. So, if you receive the tips reported to your employer, that's there on your W2. Let's say you received some tips which are there in your pocket, your employer is not aware of it, you've not reported to your employer, even that is supposed to be included as wages and salary income. So, when we talk about wages and salaries, the taxable part is of course all the cash that you receive from your employer or any property that you receive from your employer. For property, we're going to look at fair market value of that property. Now, if you're getting fringe benefits from your employer, you realize that a lot of those fringe benefits are non-taxable. So let's talk about them one by one. Let's start with the first one, life insurance. So let's say your employer takes care of your life insurance. Your employer is paying the premiums for your life insurance for coverage of up to $50,000. That benefit that you receive from your employer is a non-taxable fringe benefit. Or let's say your employer is paying for your medical insurance. Again, good news, a non-taxable fringe benefit. Now, let's talk about these insurances. Let's say, in the event of death of an employee, the insurance company would now give the benefits of life insurance to the employee's beneficiary, let's say the ex-employee's, the deceased employee's spouse. For the deceased employee's spouse, the life insurance benefits or the life insurance distributions received are also going to be non-taxable. Or let us say an employee gets hurt, gets ill, he gets hospitalized, and the medical insurance company distributes money, gives the money to reimburse for the medical expenses. Now, that benefit or distribution from the medical insurance company, which the employee has received and used to pay his hospital bills, even that is non-taxable. So what we're saying is the premiums for life insurance or for medical insurance which are paid by the employer is a non-taxable fringe benefit. Even the distributions from insurance, which of course comes in adverse times, in the event of death or in the event of illness or hospitalization, those distributions are also non-taxable. Let's move on. Let's look at the third one here, where we have qualified pension plans. And a good example here is a 401k plan, which is an example of a defined contribution plan. Now, in case of qualified pension plans, as you realize, it's a non-taxable fringe benefit. So the employer every year is putting aside money for your pensions. That is a non-taxable fringe benefit to you. Now, after you retire, you're going to be getting those pension benefits. At that point, after retirement, when you're getting the pension benefits, the pension distributions, those pension distributions are going to be taxable on your 1040. So if you realize when we said Sir you owe, the I of Sir you owe was IRAs, pensions and annuities. So during employment, when the employer is setting aside money for your pensions, it's non-taxable to you. But after retirement, when you get the pension benefits, it's going to be taxable. So basically, what's happening here is the tax payment or the tax that you pay to Uncle Sam on those pensions, the amount that the employer has set aside, would only happen after retirement once you're getting the benefits. Let's quickly summarize these three. Let's put all of them together: life insurance, medical insurance, qualified pension plans. So when there's a premium or a contribution by the employer, we said that is non-taxable to the employee. So that's clear. It's under non-taxable fringe benefits. Now, the benefits or distributions when they're received. So benefits / distributions. So the life insurance benefits or distributions after the death of an employee is non-taxable to the beneficiary. Medical insurance distributions or benefits received in the event of illness, hospitalization is again non-taxable to the beneficiary. However, we said pension distributions after retirement, that's going to be taxable. That's going to be taxable, and we know that one is the I of Sir you owe. Now, moving on. So we looked at life insurance, medical insurance, qualified pension plans as non-taxable fringe benefits. Now, we also have health savings account as another non-taxable fringe benefit, which means that if your employer is putting aside money for your health savings account, that's going to be non-taxable to you. But let's say your employer doesn't do that. Your employer is not putting aside anything for your health savings account. He's saying, take all the money in cash, do what you want. Now when you're getting your salary, you're getting your income, you are putting aside some money for your health savings account. Now, in that case, the amount that you put together for your health savings account, that's going to be a deduction to AGI. And let's look at that on a dashboard. So what I'm saying here is, let us say if your employer is paying for your health savings account, it's a non-taxable fringe benefit. It does not get included on your gross income. But let's say if the employer pays you the money and you have to take care of your own health savings account, that is actually going to be a deduction to AGI, an adjustment. So when we looked at adjustment, we said our mnemonic was wishes. The H of wishes, this is HSA deduction, where the employee himself or herself is putting aside money for his or her health savings account. So back to wages, salaries, commissions, tips, W2 income. So again, moving on, medical expenses. So if your employer is paying, reimbursing your medical expenses, that's a non-taxable fringe benefit to you. But let us say if the employer is not reimbursing medical expenses, you have to bear it. So the employer is giving you the salary, which is included on your gross income, and you have to take care of your medical expenses. Those medical expenses may be deducted on Schedule A if you choose to itemize. So if you take itemized deductions, the M of Mike, that's medical and dental expenses. So those are expenses that you've paid from your pocket and not reimbursed by the employer. So guys, if you realize HSA, medical expenses, if the employer takes care of them, it's non-taxable fringe benefit. If you have to take care of yourself, it's a deduction. HSA was above the line deduction, medical expenses is below the line deduction. Moving on, let's say a workman, a worker, an employee gets hurt, gets injured and gets workman's compensation award from the employer. That's a non-taxable fringe benefit for the employee. Note, unemployment compensation is taxable. That's when you don't have a job. Workman's compensation, this is received when a workman, an employee gets injured or hurt on the job. Okay, moving on, the next one, education expenses. The employer is taking care of your learning and development. Listen, the employer is paying for your undergrad or grad education. That's a non-taxable fringe benefit. But if the employer is paying for your CPA review course, let's say at Mike's, that's taxable. So it's going to be non-taxable if it's undergrad or graduate education. Now, how about employees of education institutions? Let's say an employee of a university, where the university is giving the employee a tuition reduction. Now, if the tuition reduction is for undergraduate education, that's non-taxable. But if the tuition reduction is for graduate level education, then the tuition reduction would be non-taxable if the employee is a teacher or a researcher and there's some additional pay that the employee is receiving besides the tuition reduction. Which means that the pay, the cash that the employee would receive, the cash that the teacher or researcher would receive, that cash would be taxable. The tuition reduction would be non-taxable fringe benefit. Moving on, the next one, a big one, stock options for all the CXOs, all the hard-working guys. So if you get stock options from your employer, that's again a non-taxable fringe benefit on grant date. So the employer grants you stock options, it's non-taxable. Now let's talk about the entire journey for a stock option. So let's say an employer granted you stock options with an exercise price of $300. You choose to exercise that stock option when the fair value of stock is $500. Note, so the exercise price, you exercise at $300 when fair value of the stock is $500. That's so cool. You've paid $300 for your companies, for your employer stock, and you've gotten the stock which is worth $500. That's like $200 of income. And that's treated as income if it's a non-qualified stock option. So in this case, you would have $200 of income, call it ordinary income. So if you realize there was no tax on the stock option on the grant date, it's only when the employee exercises the stock option that the employee pays tax. However, if the stock option is a qualified option, it's called qualified incentive stock option. In that case, the employee does not even pay taxes on exercise. Even here, there is no taxes. So if it's non-qualified, it's taxes when exercised. If it's qualified, good news, it's not even taxable even now. You've paid $300, got something worth $500. Paid $300 for the stock, got the stock worth $500, but no tax for you. Good news. Now let's build it up further. So you have the stock option which you've exercised, received the stock. Now later you sell the stock. Let's say you sell the stock for $600. So let me put that number. So you sell the stock at $600. So let's talk about what happens if it's a non-qualified stock option. Now you've paid taxes on $200 here on exercise. There's an extra $100 gain here. So you pay taxes on the $100, and this one is going to be a capital gain. So if it's a non-qualified stock option, you pay taxes first on exercise, and then let's say if the prices go up further beyond the fair value on exercise, in this case the prices went up further $100, so that tax on $100 is paid on sell of the stock. However, when it was a qualified stock option, the good news was the employee, you, did not pay a penny of taxes on exercise. Only when you sell the stock, and in this case you sold the stock for $600, only when you sell the stock do you pay taxes to Uncle Sam. And if you realize you had exercised, you paid $300 for this stock, the exercise price was $300, and now you're getting $600 for the same stock. Only now, when you have sold the stock, do you pay taxes on the entire $300. And this entire $300 is basically capital gains for you. So it's great to have a qualified incentive stock option, because number one, you pay taxes only when you sell the stock. And number two, all of the gain is a capital gain. And we'll talk about how capital gain tax rates, if it's a long-term capital gain, are lower than your ordinary tax rates. So, of course, qualified stock options do have certain holding period requirements, but if you meet all of that, it's great to have qualified stock options. It's great, it's very efficient for tax avoidance. It's very efficient for reduction, delay of taxes that you pay to Uncle Sam. Finally, on wages non-taxable fringe benefit list, I've got some miscellaneous items. Let's say you've got a company laptop and you also use it for your personal use. Let's say you spend a couple of hours every week as a routine on Facebook. That's like a fringe benefit, but it's a de minimis fringe benefit, non-taxable. Let's say you've done a great job. You've worked really hard and you get an employee achievement award from your employer. Now, up to $400 fair market value, that's fine. It's non-taxable fringe benefit. Let's say your employer has an eatery and you can eat lunch, dinner for free. Non-taxable fringe benefit. Let's say an employer provides lodging at the employer's premises for the employer's convenience. Let's say for a security guard, the employer tells the security guard that you have to stay in the premises. You will be provided lodging because that's most efficient. You would be needed anytime during the day, 24/7. The lodging that the employer provides in this case at the employer's premises for the employer's convenience is a non-taxable fringe benefit to the security guard. Let's talk about certain transportation benefits provided by employers like transit passes or parking, non-taxable fringe benefit to the employee. Let's say the employer reimburses certain qualified adoption expenses when the employee has adopted a child. Even that is a non-taxable fringe benefit for the employee. Let's say the employer sells goods or services at a discount to its employees. Again, guys, that's non-taxable fringe benefit. Page 24. We have wages, salaries, bonus, commissions, fees and tips. All of this on highlight Form W2, which is issued by employer to employee. Highlight taxable. So that's everything on Form W2 from employer plus any additional taxable compensation not included on Form W2. Right there. For example, tips which are directly received by the employee from the customers. What's taxable as wages, salaries is highlight receipts in cash or property at fair market value. Highlight tips. Highlight debt cancellation or bargain purchase of employer's property. The value of the bargain purchase is the fair market value of the property minus the purchase price. Highlight guaranteed payments received by a partner as compensation without regard to the partnership income. This underlying compensation is also subject to self-employment tax, and we'll talk about guaranteed payments in Reg 4.2. And then we've got highlight fringe benefits which are taxable, which include highlight qualified moving expenses reimbursement. So generally, if an employer reimburses an employee for moving expenses or relocation expenses, that's a taxable fringe benefit to the employee. And then highlight fringe benefits not specifically excluded. For example, personal use of company car. Make a note there, If employer has cafeteria plan, employees select their own menu of benefits, may even opt for cash. So for employers who have a cafeteria plan, employees get to structure their compensation. Employees get to choose their own menu of benefits. And now we're looking at a bunch of highlight non-taxable fringe benefits. So these are fringe benefits paid by the employer to the employee and yet non-taxable to the employee. The first one, insurance and healthcare. Highlight group term life insurance premiums paid by the employer are excluded. And right there, up to 50K. So premium up to $50,000 coverage is a non-taxable fringe benefit to the employee. Note, highlight life insurance proceeds are also excluded from the beneficiary's gross income. Next, highlight medical, health, accident insurance premiums paid by employer. Another non-taxable fringe benefit. Note, highlight Medicare benefits, accident and healthcare insurance benefits are also excluded from the beneficiary's gross income. Next, we have medical expenses reimbursed by the employer. We have health savings account or medical savings account by the employer. Put a bracket around medical insurance, medical expenses, health savings or medical savings account, and right there, paid by employer. For the employee, it is right non-taxable income. But if paid by self, that means the employee pays for it by himself, it's right deductible expense. Next, put a box around workmen compensation. So in case this is paid by the employer to the employee on account of an occupational sickness or injury, that's non-taxable to the employee. On page 25, highlight qualified pension or retirement plans. Now, generally, contributions to these plans are non-taxable to the employee. Highlight taxable to the employees only when benefits are received, which is generally after retirement. Right there, Sir U O are mnemonic for gross income and circle I. So I is IRAs, pensions and annuities. So these are distributions from the pension funds that the employee receives after the employee has retired, and that's when it is taxable to the employee. Now let's look at various kinds of pension plans. Highlight SEP, which is highlight Simplified Employee Pension. Now, it's a variation of an individual retirement account which may be adopted by employers to provide retirement benefit for eligible employees. Next, highlight Simple, which is Savings Incentive Match Plan for employees. Now, this one's a retirement plan wherein underline employees can choose to make salary reduction contributions to the plan rather than receiving these amounts as part of their regular pay. In addition, underline employer contributes either matching or non-elective contribution. Now, Simple may be set up as underline Simple IRA plan or a Simple 401k plan. Next, we have highlight qualified plans, which are generally funded by employer contributions. Now, there are two kinds of qualified plans. Number one, highlight defined contribution plan, where the employer defines the contribution made on behalf of each employee. Next, highlight defined benefit plan, where the employer defines the benefit that each employee would receive after retirement. So the first one, the defined contribution plan, could be either highlight a profit sharing plan, which allows for discretionary contributions by the employer, or highlight money purchase pension plan, where there's a fixed contribution by the employer. Now, from defined contribution plan, I want you to draw an arrow down to elective deferrals and highlight 401k plan. So elective deferrals or 401k plan is when employees choose to have the employer contribute part of their before tax compensation to the plan rather than receive that compensation in cash. This contribution is called an elective deferral because underline participants choose or elect to defer receipt of the money. Now, if the plan permits underline the employer can make matching contributions for an employee who makes an elective deferral to the 401k plan. Now that we've looked at a lot of non-taxable fringe benefits, let's do a little recap out here. So I want you to do a small table where the first column, make it premiums or contributions. And the second one, let's have benefits or distributions. And let's look at the tax effects for life insurance, medical insurance, and qualified pensions. Now, we know that premiums or contributions by the employer for the employee's life insurance or medical insurance or qualified pensions, all of that is put a bracket and write non-taxable. Now, let's talk about benefits or distributions. So, life insurance proceeds or benefits received by the beneficiary on someone's death is non-taxable to the recipient. Similarly, medical insurance benefits received. So, medical insurance benefits typically are received in case of sickness, illness, hospitalization. So these medical insurance benefits are non-taxable to the recipient. However, pension benefits received by the employees after retirement is taxable. And we know that's the I of Sir U O. Move on to page 26 and we continue to look at non-taxable fringe benefits for employees. Next, we're talking about education and tuition expenses incurred by the employer on behalf of the employee. Highlight educational expenses up to $5,250 for undergrad or grad level education is non-taxable to the employee. And right there, MBA is okay. Highlight qualified tuition reductions. And this is underlined for education institution employees. Now, if it is underlined an undergrad degree, the tuition reductions provided by the employer to the employee are non-taxable. However, for underlined graduate degree, tuition reductions provided by the educational institution to its employees are non-taxable only if the employee is engaged in teaching or research and additional pay is received by the employee. Next, we've got highlight stock options and highlight non-qualified options. Now, these are taxable when exercised by the employee. But the advantage is with highlight qualified options, which are taxable to the employees only when sold. And then we have a bunch of miscellaneous non-taxable fringe benefits. Highlight de minimis fringe benefits. These are very minimal benefits. For example, personal use of the company phone. Highlight qualified adoption expenses which are paid by an employer. Highlight dependent care benefits which are paid by an employer. Highlight employee achievement awards via gift certificates which are given by the employer to the employee. Again, there are limitations out here. Next, highlight meals provided by the employer in an employer operated eating facility. Though this is non-taxable to the employee, it is put a box around only 50% deductible by the employer. Highlight lodging offered at employer's premises for employer's convenience is non-taxable to the employee provided it is highlight required as a condition of employment. Think of a security guard who's staying in at the employer's premises for employer's convenience. The lodging provided to the guard is a non-taxable fringe benefit because it's required as a condition of employment. Next, highlight qualified employee discounts, which could again be a non-taxable fringe benefit for the employee. And the last one here, highlight transportation benefits provided to the employees. However, note that these benefits are put a box around not deductible by the employer unless they've been incurred to ensure the safety of the employee. On page 27, we're looking at put a box around Schedule B to Form 1040. And this one's for highlight interest and ordinary dividends. So part 1 of Schedule B is highlight interest. And scroll down, part 2 is highlight ordinary dividends. All your interest income and dividend income is included as part of your gross income, taxable for federal income tax purposes. Now, if the interest received is over $1,500 or ordinary dividends is over $1,500, in that case, you have to fill out a Schedule B. And we know that Schedule B is again for interest on part 1 and ordinary dividends on part 2. So it includes interest and ordinary dividends. Let's look at that in a lot of detail on the other side of my board. So we looked at wages and salaries here. Now we are building it up to Schedule B, which includes interest and dividends. Let's talk about interest. So if you have invested in bonds or treasury bills issued by Uncle Sam, that's federal bonds or federal treasury bills, and you get interest income out of all that, that interest income is taxable on your 1040. If you have invested in bonds issued by corporations and you get interest income, that's taxable. If you have bank deposits and you get interest income out of that, it's taxable. Let us say you have paid some excess tax to Uncle Sam, or you've paid some excess tax to a state government. Of course, you'll be getting a refund back. Now, along with that refund, if you get interest on that refund, that interest on tax refund is taxable for federal income tax purposes. So what we're saying is, if you get interest on tax refunds, whether it's a federal tax refund or a state tax refund, interest along with the tax refunds is always taxable. And we also said, if you invest in federal bonds and you're getting interest income there, it's taxable. However, note that if you invest in state bonds, bonds issued by state governments, or muni bonds, bonds issued by municipalities and you're getting interest income out of those state bonds or muni bonds, that interest income is non-taxable. It is tax exempt for you. So if you have state government bonds, interest is non-taxable. Again, federal government bonds, interest is taxable. Okay, now if you invest in series EE bonds and you're getting interest income which you use for higher education expenses, in that case that interest will be non-taxable. These are like education bonds. Now, besides interest on Schedule B, we also have dividends. Now, dividends which are ordinary are taxed at ordinary tax rates. But if your dividend is a qualified dividend, it's going to be taxed at a lower tax rate. Let's look at the criteria for qualified dividends. To understand that, I'm going to build up a timeline. So let's say this is my timeline, and here this one is my X dividend date. So X dividend date is the date after the dividend has been paid out. And I'm going to go 60 days before this X dividend date. So I'm going to do minus 60 days here and plus 60 days here. So this becomes a total of 121 day period. Now if in this 121 day period you hold stock for over 60 days, the dividend received becomes a qualified dividend. So let's say you buy stock 40 days before the X dividend date and you hold it until, let's say, 25 days after. That's over 60 days. The dividend that you receive here, that dividend is a qualified dividend, taxable at a lower tax rate. Or let's say you buy stock just, let's say, 5 days before the X dividend date, but you continue holding it months after. As long as you've held it for over 60 days in this 121 day period, it's a qualified dividend with a lower tax rate. So for the rich guys, the high income guys, the 37% tax bracket guys, the tax rate on qualified dividends is only 20%. For most taxpayers who are in the 20s and the 30s tax bracket, the tax rate on qualified dividend is 15%. For taxpayers who are in the 10 or 12% tax bracket, the low income taxpayers, for them the tax rate on qualified dividends is 0%. So guys, if you meet the holding period requirement, you pay a lower tax on your dividend because your dividends now become qualified dividends. Very quickly, let's talk about non-taxable dividend, which is non-taxable on your 1040. If it is a return of capital. So dividend is when the corporation makes money and distributes that return to you. But if the corporation is returning your own capital back to you, they've not earned anything. That's not income. That's return of capital, non-taxable. Let's say if you get stock dividends. Let's talk about stock dividends. Let me give you an example. Let's say you buy 100 stocks of a company and you pay, let's say, $1,000 for those 100 stocks. So basically, you pay $1,000 for 100 stock. That's $10 per stock. Your basis in the stock is $10 per stock. And now this corporation gives out a stock dividend where they're giving one stock as dividend for every 4 stocks held. So now you're going to be getting a dividend of 25 stocks. So 25 stock as a stock dividend. My question is, how much did you pay for this extra 25 stock? I know the answer is nothing. You paid nothing for this. So now you own a total of 125 stocks. So you own this entire 125 stock and you've paid $1,000 for the entire 125. Let me do a total. So you've paid a total of $1,000 for this entire 125 stocks. So your basis in the stock is not 10 anymore. It's actually 1000 by 125, which is actually $8 per stock. You realize? So if you have a stock dividend, it's non-taxable. What you basically do is allocate the original basis over the increased count of stocks. Let's say what happens when you sell the stock. Let's say you sell the stock for $14 each. Now, if you had sold the stock before the stock dividend, your capital gain on each stock would have been 14 minus 10, $4. But now, if you sell the stock after the stock dividend, you will have higher capital gains. Your capital gains will be 14 minus 8, which is $6 per stock instead of 4. So basically what's happening is you're not paying any tax on the stock dividend. But once the company, the corporation gives out a stock dividend, you allocate the original basis, $1,000, or the increased number of stocks held. Similarly, stock splits, even that's non-taxable. Okay, let's talk about life insurance dividend. Again, life insurance dividend is like the life insurance company returning back your premiums to you. It's like a return of capital. And return of capital, non-taxable. Or let's say if you receive a dividend from a S corporation, we're going to talk about S corps, which are flow through entities. That dividend is non-taxable. So all the taxable dividends that we're talking about here are C corporation dividends. And of course, we're going to spend a lot of time, Reg 3 through Reg 4, talking about C corps and S corps. But S corp dividends is non-taxable. So guys, that's about interest and dividend, which are included on Schedule B to form 1040.
On page 28, we're looking at interest income. On the first bullet, highlight taxable. So interest from highlight US federal bonds, US treasury bills and other US obligations are taxable. The next sub-bullet, highlight corporate bonds. Or if there is, highlight any interest paid by federal or state government on late payment of tax refund. Now, in case of any bond premium or bond discount which is amortized, that needs to be adjusted from taxable interest. So in the last sub-bullet under taxable, draw an arrow and write taxable interest on bonds equals interest received plus any bond discount amortization and minus any bond premium amortization. Now, we'll study in detail about bonds, bond discount, bond premium in FAR, financial accounting and reporting. But now for tax purposes, you know that the taxable interest is interest received plus any bond discount amortization and minus bond premium amortization. On the next bullet, we have highlight non-taxable interest. So this is interest income which is underlined reportable but not taxable. And the big one here is highlight state or municipal bond interest. And just to recap all of this, let's make a little table on the top of the page. Right, interest on bonds and also write interest on tax refunds. Two unrelated things, but we're putting it together. The first column, say federal, and the second column, say state or local. So interest on federal bonds, that is right, taxable. Interest on federal tax refunds, right, taxable. Talking about state or local. Interest on state or local bonds, right, non-taxable. But interest on state or local tax refunds, that is right, taxable. So guys, this table will serve as a little cheat sheet for you when they try to confuse you on the CP exams between federal and state, between interest on bonds and interest on tax refunds. Before we move on, let's look at the last sub bullet on this page under non-taxable. Highlight Series EE and Series I savings bonds are not taxed on redemption if used for qualified higher education expenses, and circle if. On page 29, we're looking at dividend income. In the first bullet, highlight taxable. And the point is, highlight all dividends are taxable. But there is, highlight a special lower rate of 0 to 20% for qualified dividends. And these are dividends received on stocks held for over 60 days during the 121-day period that begins 60 days before the ex-dividend date. So the tax rate for qualified dividends starts at highlight 0%, goes to 15%, and the highest rate for qualified dividends is highlight 20%. On the next bullet, highlight non-taxable. So it's non-taxable when it's not dividends but actually a highlight return of capital. Or if it is highlight stock dividends to common stockholders, where the stockholders highlight allocate the original basis to the increased number of stocks held. However, stock dividends are right taxable if, and draw a bracket around the two sub bullets. There is underlined an option of receiving cash dividend in lieu of stock dividends. Or if stock dividends are given to underline preferred stockholders. Also, highlight life insurance dividend is non-taxable. That's basically a return of premium or capital. However, any interest on that life insurance dividend, that would be taxable. And the last but not the least, highlight S Corp dividends are non-taxable. And we will talk about this in Reg 4.1.
If the entrepreneurial bug bites you and you decide to start your own business, let's say a sole proprietorship concern, then while filing your tax return, you're going to be filling out a Schedule C for your profit or loss from business. And of course, that business income or profit from business will flow into your gross income on your Form 1040. So let's look at Schedule C in a lot of detail on the other side of my board. So we've got wages and salaries out here, we've got Schedule B, interest and dividend. Now we're looking at Schedule C, business income. So of course, you start with your top line, sales. So you're going to have gross sales minus any returns or allowance gets you to your net sales, less COGS or your cost of goods sold gets you to your gross profit, plus any other business income minus all the business expenses. Guys, this is the schedule for everything which relates to your sole proprietorship business. So you're going to have everything which relates to that business. Right? So business income here, other income, business expenses gets you to your net profit or loss from business. Now, when we are talking about business expenses out here on Schedule C, let's talk about wages. So these are wages and salaries that you pay out to the employees that you've hired in your sole proprietorship concern. Note that you as the entrepreneur, you as the business owner, you cannot be paying wages and salaries to self. That's not allowed as an expense. Next, if you have paid any business taxes, let's say the state government or local government, that is deductible on Schedule C. These are not your personal taxes, these are your business taxes. So, taxes that you've paid for your business. Let's say you have some office expenses, again, that's deductible out here. Let's say you've taken some business loans and you're paying interest on that. So interest on business loans is allowed as an expense here. So interest on business loans. Now, if you remember, when we spoke about basis of accounting, and we said if you have an interest on loans or interest that's prepaid, you need to allocate that interest to the relevant periods even if you are a cash basis taxpayer. So basically the logic for interest, prepaid interest, is that it needs to be allocated whether or not you are a cash basis or accrual basis taxpayer. Okay, moving on. So we've spoken wages, taxes, interest in business loans. How about food? How about business meals? So if you spend money on business meals, note that that's only 50% deductible. If you spend money on business entertainment, note it's 0% deductible. If there is business travel expenses, that's 100% deductible. That's fine. But if it's business meals in the same city, that's only 50% deductible. Let's talk about bad debts. Now, a question for you. If the sole proprietor, if you are a cash basis taxpayer, can you have a bad debt? Think about it. A cash basis taxpayer would recognize income only when he receives the money. So there's no question of bad debt. So bad debt expense would only be if you're an accrual basis taxpayer. And even when you recognize those bad debts, you recognize using the direct write-off method, which is different from the allowance method that's used under GAAP. So under direct write-off method, you recognize a bad debt only after your customers refuse that they won't pay. And again, bad debt expense would be only if you are an accrual basis taxpayer. You could have depreciation and amortization expense out here on your Schedule C. So this is depreciation and amortization of your business assets. Now, when we get to Reg 2, we're going to talk about accelerated depreciation, which is allowed. We'll talk about Section 179 expense. We'll talk about bonus depreciation. So all of that we'll talk in Reg 2. Now let's say as a business, you've paid certain fines, penalties, you've paid kickbacks. All of that is not allowed on Schedule C. Let's say there have been some illegal expenses. Can't deduct them on Schedule C. Let's talk about drug dealers who buy and sell drugs. Of course, the illegal expenses they can't deduct. But even for drug dealers, they are allowed to deduct the cost of goods sold on Schedule C. Interesting, isn't it? Now, let us say, as a business, you've done some charity. that charity is non-deductible on Schedule C. However, on your 1040, let's get there. On your 1040, if you've done charity, you could deduct charity as an itemized deduction on Schedule A. Look at this. Mike takes interest in charity and casual outing. So your charity that you've done can be deducted on your Schedule A. Let's talk about you as a proprietor, your personal expenses. Let's say the business has paid your health insurance. That's like a personal expense. You cannot deduct it on Schedule C. However, we'll talk about this. You can deduct it as an adjustment to AGI. The first S of wishes, this stands for self-employment benefits. It includes the self-employed health insurance. Let's say your business has paid some personal taxes to the state and local government on your behalf. Again, that's not deductible on Schedule C. Guys, note, anything that's personal to you as a sole proprietor is not deductible on your Schedule C. However, your state and local taxes can be deducted on your personal Schedule A. So the takes here is taxes. Let's say your business again has paid your home mortgage loan, has paid interest on your home mortgage loan. Again, as I said, Schedule C is business, it's not personal. So if it's personal home mortgage loan, put it deducted on Schedule A in interest out here. So you got to be careful. Proprietors' personal expenses, they are not deductible on Schedule C. Let's say you go out on a date with your girlfriend and you spend $1,000. So you spend $1,000 on meals. Can you deduct that on Schedule C? Again, it's not business. It's not a business meal. It's a personal meal, not deductible here. Let's say you go on a holiday to Paris and you spend $5,000. Is that business travel? No, that's personal travel. Cannot deduct it on Schedule C. Now, if your business is not so profitable, you just started, you're putting in all you can, but there's still a loss in your business, you have a net loss. We call that a net operating loss or NOL. Now, your net operating loss that you have from your business is deductible against other sources of ordinary income. Let's say if you have wage income, you have some salary income, you have some farm income, so you can deduct it against other sources of ordinary income, or let us say you can deduct it against passive income. You of course cannot deduct NOL from your capital gains or from your portfolio income. Now, let us say you do not have enough income to offset all your NOL. You still have a net operating loss on your 1040. In that case, you're allowed to carry forward your net operating loss and deduct it against future income, against future business income or against future ordinary or passive income. So guys, net operating loss or NOLs are allowed to be carried forward indefinitely.
On page 30, we are looking at put a box around Schedule C to form 1040, which is about highlight profit or loss from business. And we're talking about highlight sole proprietorships. Highlight the heading income for part 1. We start with line number 1 for highlight gross receipts or sales. Line number 2 is highlight returns and allowances. Line number 4 is highlight cost of goods sold, which leads us to line number 5, which is highlight gross profit. And then we add line number 6, which is highlight other income, to get to line 7, which is highlight gross income. And then part 2, the heading highlight expenses. So we have all the expenses out here, and on line 28 it is highlight total expenses. Line number 30 is highlight expenses for business use of your home. And that gets us to line number 31, which is highlight net profit or loss from business. A little note at the bottom of the page, right there. There are two federal taxes which are paid on self-employment income. Number one, of course, is the federal income tax. And number two is, right, self-employment tax, which is computed on, put that in brackets, Schedule SE. Turn to page 32, and on the second bullet there, put a box around format for Schedule C. And we've just seen that, starting with gross receipts, and the bottom line is the net profit or loss from business. On page 33, the second bullet, the second sub-bullet, put a box around inventory. So now, accounting for inventory, highlight if using accrual basis of accounting, inventory is valued at lower of cost or market. The taxpayer may use specific identification, FIFO or LIFO method. But remember, underline as per LIFO conformity rule. If LIFO is used for tax, it must also be used on the GAAP books. However, a lot of small businesses highlight use cash basis of accounting. Now, in that case, they're not required to use accrual method to calculate COGS and inventory. They may use either of the options. So option one is to highlight treat inventories as non-incidental materials and supplies. Circle or highlight conform to the taxpayer's financial accounting treatment of inventories. Now moving down on this page, the third bullet, we have total expenses, which include ordinary and necessary business expenses. The first one there, highlight wages. So that's wages, salaries, commissions, and employee benefits paid to others. But underline, cannot pay to self. So the sole proprietor cannot pay salaries to himself and deduct on Schedule C. That's not allowed. Next one, highlight taxes. So these are all the business, highlight state and local taxes paid. And of course, it's not underline federal income tax. Then the office expenses of the business like rent. Expenses also include highlight interest on business loans. Note, highlight prepaid interest cannot be deducted even by a cash basis taxpayer in the year paid. So prepaid interest has to be accrued to the year to which the interest relates. And just to refresh yourself, right, refer exception number 2 on Reg 1, page 19. Now, there is also, put a box around, a business interest expense limitation. The net interest expense, that's the interest expense less any interest income deduction, is limited to 30% of adjusted taxable income plus any floor plan financing interest. In other words, highlight annual reduction of interest expense is limited to the sum of number one, business interest income, put a plus sign, circle 30% of adjusted taxable income, and put a plus sign, highlight floor plan financing interest. Where floor plan financing applies to dealers of motor vehicles, boats, farm machinery or equipment, wherein dealers often obtain loans against the high cost inventory. However, this business interest expense limitation underline does not apply to small businesses. Turn to page 34, where we have deduction for highlight business meals, which are only 50% deductible. And that too, the meals should be underlined without any entertainment value. Because highlight business entertainment expenses, including membership dues, are now non-deductible. Next, we've got highlight business travel, which is 100% deductible, and it includes meals on business travel. Next, highlight transportation expenses. Underline between two regular or temporary work locations, or underline between home and temporary work location. Does not include commute, which is between home and the regular work location. So expenses on Schedule C also include highlight fringe benefits provided by the sole proprietorship business to its employees. Most of those are fully deductible. Circle exceptions, highlight meals provided in employer operated eating facility, which is only 50% deductible. Underline transportation benefits for travel between employee residence and place of employment. These are no longer deductible unless they are incurred to ensure the safety of the employee. Then you have deduction for highlight business gifts, which is underlined up to $25 per recipient per year. Next, highlight business bad debts. And these are expenses allowed underlined for accrual basis taxpayers only. And this is because, right, cash basis taxpayer can't expense bad debt. Now, the reason is clear. A cash basis taxpayer would not even recognize revenues until he receives the cash. So if there is a default by a customer, the cash basis taxpayer who's not recognized revenues need not recognize the bad debt expense. Now, even for accrual basis taxpayers, right, GAAP method is allowance method, whereas for tax, the taxpayer needs to use, right, the direct write-off method. Now, in case of any highlight non-business bad debts and circle non. So, for example, a loan to a friend which the friend did not return back. These are underlying short-term capital losses which go on to Schedule D. So, business bad debts, they are expense items on, draw an arrow and write Schedule C. Whereas non-business bad debts, they go to write Schedule D. And then businesses have expense for depreciation and amortization. Draw a bracket there and write cover in Reg 2. Move to page 35, where we have highlight non-deductible expenses on Schedule C. First one, highlight salaries to sole proprietor. These are actually drawings and they are not deductible on Schedule C. Highlight federal taxes. Highlight fines and kickbacks. Illegal business expenses. Highlight business entertainment expenses. Highlight employee transportation. Highlight charitable contributions. Now, if the sole proprietor does charity, that is underlined deductible in Schedule A as itemized deductions. So we know that Mike takes interest in charity and casual outings. So charity, that's a Schedule A itemized deduction. The last one here, highlight proprietor personal expenses like transportation, travel, vacation, proprietor's personal meals and entertainment. Highlight health insurance of proprietor. Or highlight state and local tax paid by the proprietor as an individual. Highlight interest expense of the proprietor for mortgage interest or for investment interest expense. Now draw a bracket around these and write deductible elsewhere on the proprietor's Form 1040, but not on Schedule C. On the next bullet, highlight net operating loss or NOL. So NOL is highlight generally a business loss, and an individual having a net operating loss highlight can carry forward the unused NOL indefinitely. However, carry back for NOL is no longer allowed. So underline no carryback. Now, even when the NOL is carried forward, there are certain highlight limitations. So number one, NOL deduction is limited to 80% of taxable income. And number two, highlight excess business losses are not deductible. Do we say that NOL is business loss? NOL for an individual underline may also occur if an individual is not engaged in a separate trade or business. For example, a personal casualty or theft loss. For example, right, salary minus casualty loss on Schedule A equals NOL. NOL highlight can be offset against wages or salary income, business income, or rental income, or even farm income. But underline, not interest, dividend, or capital gain.
Let's now talk about UNICAP, which stands for Uniform Capitalization Rules, which apply to manufacturers, wholesalers, retailers. So UNICAP or Uniform Capitalization Rules is a set of guidance as to what needs to get capitalized on their balance sheet. Because whatever isn't capitalized is actually an expense on the tax income statement. So let us say when you have these businesses calculating their COGS, inventory on the balance sheet, that is where they use the UNICAP guidance. Now let's talk about the capitalization requirements as per GAAP. So if you're looking at expenses before production, research, design, purchasing expenses, and then production expenses, direct materials, direct labor, and overheads. Or after, post-production expenses like G&A, warehousing, advertising, selling, and distribution. Now, as per GAAP, pre-production cost, everything is an expense on the income statement. Post-production cost, all of those are expense on the income statement. Only production costs are what we call product costs, which are allocated between the income statement and balance sheet, which means that unsold inventory is capitalized on the balance sheet. So capitalized per GAAP. So only the direct materials or the direct labor and the overheads of the unsold inventory is what gets capitalized as inventory as per GAAP rules. Now under UNICAP rules, basically you end up capitalizing a little more. Now even under UNICAP, research is an expense, but design could be capitalized. Purchasing expenses may be capitalized. Let's say G&A, production related, capitalized. Certain warehousing costs could be capitalized. Advertising, that's an expense. Selling and distribution, that's an expense. So you're talking about off-site warehousing, which may be capitalized under UNICAP. So what is happening here basically under UNICAP is the unsold portion of inventory, the unsold goods, inventory, not only capitalized, not only includes the production costs like direct materials, direct labor, and overheads, it also includes a bit of pre-production cost and post-production cost. So it's basically more capitalization per UNICAP. So the purpose of UNICAP basically is to have a set of uniform capitalization rules for all businesses. And what you realize here is UNICAP capitalizes more than GAAP. Basically, if more is capitalized, there will be less expense on the income statement, on the tax income statement. Less expense means a higher profit and higher amount of tax to Uncle Sam. Now note that the UNICAP rules apply to all large businesses, but there are small manufacturers or small wholesalers or small retailers who are exempt from the UNICAP requirements.
On page 36, we've got highlight UNICAP or the Uniform Capitalization Rules, which applies to property produced for use. For example, highlight building constructed for own use, property produced for sale. For example, highlight manufacturer's inventory, or property acquired for resale. For example, highlight wholesalers or retailers inventory. Now underline, small manufacturers are exempt from UNICAP requirements. Similarly, underline, small wholesalers and retailers are exempt from UNICAP requirements. Now let's put the UNICAP requirements in place. So let's first look at all the expenses. So let's classify them as, right, pre-production, production and pre-sales costs. For pre-production, let's have research and design. And you could scratch off research because that's not capitalized. For production, you have direct materials, DM, direct labor, DL, and overheads. Under pre-sales costs, let's have warehousing, advertising, and selling and distribution. And you could scratch off advertising and selling and distribution because they are not capitalized under UNICAP. Now draw a bracket from direct materials through overheads and right there, capitalize as inventory under GAAP. And draw another bracket which is from design under pre-production through warehousing on the pre-sales costs and write capitalize as inventory under UNICAP. The next bullet, we've got rules for highlight long-term contracts where taxpayers are required to highlight use percentage of completion method. However, underline small businesses may use the completed contract method. On page 37, we're looking at put a box around Schedule D, which is for highlight capital gains and losses. And right there, cover in Reg 2.1. So we'll cover capital gains and losses in detail in Reg 2.1. But let's quickly browse through the form right now. So if you look at part 1, it's short-term capital gains and losses. So these are generally assets held 1 year or less. Highlight short-term. Part 2 is long-term capital gains and losses, which are generally assets held more than 1 year. Highlight long-term.
Let's now look at Schedule D, which is your schedule for capital gains and losses. Now, you're going to have a capital gain or loss when you're selling a capital asset. So let's say an investment in stock or a bond is a capital asset, or your house property, that's a capital asset. Now, whenever you sell a capital asset, we're going to look at the amount that you've realized from the sale, and we're going to compare that amount realized to the adjusted basis of the asset sold. If the amount realized is higher than the adjusted basis of the asset sold, good news, you have a capital gain. But if the amount realized is lower than the basis of the asset sold, you have a capital loss. Both capital gains and losses get into your Schedule D. Let's say you have a stock which you've now sold for $500. You've realized $500. The basis in the stock, you bought that stock for $300. That means there's a $200 capital gain for you. Let's say you just sold your house for $400,000. You've realized $400,000. You had bought that house many years ago for $150,000. So the basis was $150,000. You've realized $400,000, which means your capital gain is $250,000. Now, whenever we look at capital gains and losses, beware, note the holding period. If the holding period is 1 year or less, it's a short-term capital gain or a short-term capital loss. If the holding period is more than 1 year, that's when it's long-term. Now, this is important as the tax rates vary between short and long-term capital gains. Let's look at that. So, if you have a short-term capital gain, the tax rate on short-term capital gains is the same as your ordinary tax rate. But if you have a long-term capital gain, the tax rate for long-term capital gains is a lower, reduced tax rate. So let's say for taxpayers who are in the 10% or 12% tax bracket, the low income guys, for them the tax rate on long-term capital gains is 0%. For most taxpayers who are in the 20%, 20s and 30s tax bracket, for them the tax rate on long-term capital gains is 15%. For the rich guys, high income taxpayers who are in the 37% tax bracket, for them the tax rate on long-term capital gains is 20%. So basically what we see is the tax rate on long-term capital gains is lower than your ordinary tax rates. And guys, if you recall, we had seen exactly the same rates when we did qualified dividends. So even for qualified dividends, we've seen here that there's a lower tax rate which is from 0% to 20%. Same rates that you see for long-term capital gains. Just one last point. Just in case you have a net capital loss, which means you have more capital loss than the capital gains, a net capital loss. You can deduct a net capital loss that you have out here from other sources of income to the tune of $3,000 each year. But let's say if you have a net capital loss which is more than that, let's say your net capital loss is $7,000. You can take out $3,000, deduct against other sources, other baskets. Anything on top of that, you carry it forward. When you carry it forward, you can use the net capital loss to offset capital gains in the future. Or if you don't have capital gains in the future, you can take out $3,000 again each year from your capital gain basket and deduct against other baskets.
Turn to page 39. And on the second bullet there, highlight short-term capital gains, which are treated as ordinary income and generally taxed at highlight ordinary tax rates. Highlight long-term capital gains, which have a 0% to a 20% tax rate. On the third bullet, highlight net capital loss. Highlight maximum deduction of net capital loss from other sources of gross income is $3,000 per year. For any net capital loss, there is highlight no carryback but may carry forward indefinitely.
We are now looking at Schedule E, which is supplemental income or loss. So here we are looking at all the sources of passive income. Let's say you have a house property which you've given out on rent, and now you get rental income. That's passive income or supplemental income going into Schedule E. You have written a book, or you own an intellectual property. You're getting royalty income. Again, supplemental income on Schedule E. Or let's say you're a partner in a partnership, or a shareholder in an S corporation, or a beneficiary of an estate or trust case. All of this, these entities, we call them flow-through entities. And if you have income from any of these, it flows through and is included on your Schedule E to be taxed on your 1040. All these flow through entities, they send you a K1 every year. It's called a Schedule K1. So let's say you're a partner in 4 partnerships and you're a shareholder in 3 S corporations. Every year you're going to be getting 7 Schedule K1s, 4 from the 4 partnerships and 3 from the 3 S corporations. You're going to put all the 7 together on your Schedule E, club them all, because that's all your income from flow through entities, and that Schedule E, supplemental income, basically is included on your gross income on Form 1040.
We are now on page 40, where we're looking at put a box around Schedule E, which is for highlight supplemental income and loss. From highlight rental real estate, royalties, partnerships, S corporations, estates, trusts, etc. So part 1 of Schedule E, that's income or loss from highlight rental real estate and royalties. Move to page 41, where we have the second page of Schedule E. On part 2, we've got income or loss from highlight partnerships and S corporations. And on part 3, we've got income or loss from highlight estates and trusts. Let's look at the line of caution just above part 2. It says the IRS compares amounts reported on your tax return with amounts shown on, put a box around, Schedules K1. So an individual gets a K1 from each partnership that he's a partner in. He gets a K1 from each S corporation that he's a shareholder in. Or he gets a K1 from estates and trusts where he's a beneficiary. And IRS compares amounts reported on the individual's tax returns with the amounts shown on all those schedules K1. So on top of this page, make a note right there. Partnerships, S corps, estates and trusts. All of these are right flow through entities. And we're going to cover them all in Reg 4. Turn to page 42. And once again, we're looking at Schedule E, which includes income from highlight rental real estate, highlight royalties, and highlight income from Schedule 1. So that's the income from flow through entities, including partnerships, S corps, estates, and trusts. Moving down on this page, we're looking at income from rental real estate. So calculating net rental income or loss. So we're going to start with highlight gross rental income. And if it is a cash basis taxpayer, that's equal to cash received. That's the rental received. If it's accrual basis taxpayer, then the gross rental income would be rent earned, including dues. Now the net rental income or loss includes highlight prepaid rental income. So that's rental income received in advance, which is included as income for the year, even if accrual basis. So this was an exception for accrual basis taxpayers, where if they receive rental income in advance, it's treated as income in the year received. So that's even before it's been earned. Highlight lease cancellation payment. Highlight lease improvement in lieu of rent and underline in lieu of rent. And draw an arrow down from lease improvements. Where you need to note that lease improvements are non-taxable to the lessor unless those lease improvements were made by the lessee in lieu of rent. And then there is a deduction for highlight rental expenses, which leads to highlight net rental income or loss. Right, general rule or GR, all rental income equals passive activity. So if there is a loss from rental activity, there'll be a passive activity loss. And the rule is highlight passive activity losses can be generally offset against passive income only. If there's a loss, you can highlight carry forward indefinitely, circle or highlight until activity disposed. Now there are a couple of exceptions out here. The first one, right, except if RE or real estate equals active. And this is also called, right, mom and pop exception. So basically this is a scenario where the taxpayer actively participates in the real estate. So circle active, underline participation. And in such a scenario, highlight rental losses are partially deductible from any active and portfolio income. But here there's a limit, right? Up to $25,000. So the taxpayer can deduct only up to $25,000 of rental losses from other sources of income like active and portfolio income. And even this $25,000 is subject to phase out, which means that if the taxpayer is rich, let's say the taxpayer has AGI in excess of $150,000. In such a scenario, the taxpayer will not be allowed to deduct rental losses from any sources of income, even if there's an active participation. But if the AGI of the taxpayer, let's say, is less than $100,000, then the taxpayer can deduct up to $25,000 of rental losses from other active and portfolio income. The second exception is in case of circle material and underline participation. So material participation, basically we are talking about highlight a real estate professional. For a real estate professional for whom real estate is a business, highlight rental losses are fully deductible from any active and portfolio income. Moving to page 43, we're looking at a special scenario of highlight rental of vacation home. So this is a real estate property, underline used as a home, circle and underline rented for 15 days or more during the year. So this is a home plus there's rental income because it's rented out for 15 days or more during the year. In this scenario, highlight rental income is included on Schedule E, and as far as the expenses are concerned, highlight mortgage interest and property tax deductible on Schedule E for the period rented. Highlight property expenses like utilities, insurance, depreciation, you need to highlight prorate between personal and rental use. And let's look at the example that we've got here. So it says Richie rents his vacation home in California for 3 months in a year and lives there for 2 months. Note that during the rest of the year, he lives in the city. Rental income from the vacation home is $7,500. For the vacation home, he pays real estate taxes of $3,000. There's interest expense of $4,200, utilities of $4,500, and depreciation of $6,000. And you're required to calculate the net rental income or loss which goes into Schedule E. So of the 5-month period, the vacation home is used 2/5 for personal use and 3/5 for rental use. Of course, the remaining 7 months seems that the vacation home remains vacant. Now let's look at highlight rental income on Schedule E. So the rental income for the 2 months that the vacation home is let out is $7,500. So expenses that we've seen are highlight mortgage interest and taxes, and we're going to expense on Schedule E for period rented. So the vacation home is rented for 3 months in a year out of a total of 12 months. So taxes of $3,000 and interest expense of $4,200, total $7,200 is multiplied by 3 by 12. So you're going to look at it, what's the taxes and what's the interest for 3 months out of 12. And that calculates to $1,800. The remaining $5,400 of taxes and interest on the mortgage loan, these are itemized deductions, and we look at all of them on Schedule A. Next, we've got highlight property expenses which need to be prorated between rental and personal use. So the property is being used for 5 months in a year. Out of 5 months, it's let out for 3 months and 2 months is Richie's personal use. So when we have the utilities and depreciation expense of $4,500 and $6,000 respectively, total of $10,500, that's multiplied by 3:5. So out of utilities and depreciation expense of $10,500, $6,300 are deductible on Schedule E. So if we look at Schedule E, the rental income is $7,500. The taxes and interest that's allowed for the period rented, that's $1,800 of an expense. Property expenses, utilities and depreciation, that's $6,300 of expense on Schedule E. So the net rental loss on Schedule E for Richie is going to be $600. Now, since this one's a passive activity loss, a net rental loss, it's not deductible from other sources of income, but it's carried forward and applied against future income from this property.
We're now looking at Schedule F, which is profit or loss from farming. So F for farm income. Now, Schedule F is very similar to Schedule C. Just that in this case, the taxpayer is a self-employed farmer.
On page 44, we have highlight Schedule F, which is highlight farming income. And that is highlight running a farm for profits. So here we're talking about, a self-employed farmer.
Uncle Sam imposes payroll taxes on all the salaried guys working. He imposes self-employment tax on the self-employed guys. Now, using all the money that he gets using those payroll taxes, self-employment taxes, he uses that to give out social security benefits to those who are retired. So for the retired folks, social security benefits is income, which may be taxable on their 1040. So whether the social security benefits are taxable or non-taxable, that depends on the income levels of the retired individual. For the low income folks, social security benefits may be non-taxable. But for the high income folks, social security benefits may be taxable to the tune of 85% of the social security benefits.
On page 45, we are starting to look at line items included in gross income. And our mnemonic here is SIR-UO. So towards the bottom of this page, we have social security benefits, which is right S of SIR. Now 0 to 85% of social security benefits may be taxable based on the income level of the taxpayer. Highlight if provisional income is less than $25,000 or less than $32,000 if married filing joint, social security benefits are 0% taxable. In other words, social security benefits are fully excluded by low income taxpayers. But underline up to and also highlight up to 85% must be included in gross income by high income taxpayers.
We've seen that when employers set aside money towards qualified pension plans, it's a non-taxable fringe benefit to the taxpayer. However, when the taxpayer retires and he starts getting those pension benefits, that is income on 1040. So after retirement, the pension benefits are included as income on the I of SIR-UO. The I also includes IRA distributions. These are distributions from the individual retirement account where the individual had set aside money for retirement savings and now after retirement he is getting the benefits. Now note, when the individual is setting aside money towards his or her own IRA during the working career, it is allowed as an adjustment to AGI. So the I of wishes, that's IRA deduction. So during the working career, when the individual is setting aside money for IRA, it's an adjustment, a deduction to AGI. After retirement, when the individual is getting the IRA distributions, the benefits, that is included in the I of SIR-UO as part of gross income. So this deduction and tax applies to traditional deductible IRA. Now the different rules for Roth IRA, and we'll cover this in detail when we're looking at a mnemonic wishes and we get to the I of wishes, which is IRA deduction.
On page 46, we're looking at income from IRAs, pensions and annuities. Write an I out there, and that's the I of SIR-UO. So we have income from IRA or individual retirement account distributions. Now IRAs could be, put a box around traditional deductible IRA, put a box around Roth IRA, or even put a box around non-deductible IRA. And we're talking about highlight taxes on distribution, generally after retirement. So when the individual is receiving distributions back from the individual retirement account. Now, if it is a traditional deductible IRA, highlight both the principals and earnings are taxable. So it's a yes and yes. But if it is a Roth IRA, neither the principals nor the earnings are going to be taxable. Highlight no and no. For non-deductible IRA, highlight no for principal and yes for earnings. So when we are looking at the adjustments to AGI, we will talk in detail about IRAs and IRA deductions. And at that point, I'll also cover the logic for taxes on distribution of IRAs. Let's look at the next one. Pensions and annuities. Put a box around qualified pension or retirement plans. Underline, contributions by employer or employee are excluded from income. So it's a non-taxable fringe benefit for the employee. However, highlight distributions which are generally after retirement are fully taxable.
Let's say in year one, you pay out $1,000 of state taxes, which you claim as an itemized deduction on Schedule A. Next year, in year two, out of the $1,000, you actually get a refund back from the state government of $300. Now, you don't have to go back to year one and revise your 1040, change that $1,000 to $700. No need of doing that. The $300 refund that you got in year two would be included as an income as part of SIR UO, because the R of SIR is refunds of state taxes which are included as part of your gross income on 1040.
Back on page 46, we're looking at refunds of state taxes. And this is right R of SIR UO. And the question for the individual taxpayer here is, right, did you deduct state tax on Schedule A last year? And right, if yes, pay tax on refund received this year. Couple of notes here. The first one, highlight federal tax refunds are never taxable. And underline, since federal taxes are never allowed to be deducted on the federal tax return. And right there, may only deduct state and local taxes on Schedule A. And the next one, highlight interest received on both federal and state tax refunds are taxable under interest. And we've seen this on Schedule B. So right there, taxable on Schedule B.
Let's say you haven't been able to find a job. You are unemployed. Uncle Sam will take care of you. He's going to give you unemployment compensation. But that unemployment compensation will be taxable on your 1040, because that's the U of SIR UO.
We are back again on page 46. We'll be looking at income from unemployment compensation, which is, as we know, right, U of SIR UO. and highlight unemployment compensation is taxable. And on another note, underline workmen's compensation is non-taxable because that's a non-taxable fringe benefit.
The O of Sir You owe is all your other income. And my favorite one here is your gambling winnings from Vegas.
On page 47, we've got other income, which is right O of Sir You owe. Highlight discharge of indebtedness, which means a debt which had been taken by the taxpayer is now being forgiven by the lender. And this one becomes taxable to the taxpayer. However, it is underlined non-taxable if income from student debt discharged due to death or disability. Next, highlight gambling winnings. So these are all your winnings from gambling, from lotteries, from Vegas. Now, when we get to Schedule A, we'll also talk about gambling losses which are allowed as deduction to the tune of gambling winnings out here on other income. Next one's interesting. Highlight illegal or embezzled income. Even that's supposed to be included on your 1040. However, underline for illegal drug income, only COGS or cost of goods sold is allowed to be deducted. Highlight jury duty fees. So even that's other income. Highlight prizes and awards which are taxable at fair market value. However, for prizes and awards, draw a bracket around the three sub-bullets there and write non-taxable if all three met. Let's read all the three conditions that could make prizes and awards non-taxable. So condition 1 says selection without any action on the recipient's part. That means the recipient did not try to enter a contest. The second one, services are not required of the recipient. And the third condition is that charity or government gets the payment as assigned by recipient. So basically, if the recipient or the taxpayer got a prize or award without getting into any contest, without providing any services, and immediately diverts the prize or award money to charity or government, in that case, the prize or award becomes non-taxable. Next, highlight punitive damages. So here, the taxpayer was a victim of age or race or sex discrimination, and now the taxpayer is receiving a punitive damage award. So that's other income. Note that the word punitive comes from the word puny, which is punishment. So the other guy who had discriminated against the taxpayer is now being punished, and he's having to pay punitive damages, which is actually income for the taxpayer in question. Next, highlight scholarships and fellowship grants, which is going to be taxable for, highlight all non-degree students, and it's going to be taxable if the recipient is, highlight degree students, where the degree student is receiving the grant or tuition reduction as, highlight compensation for services like teaching, research, etc. However, the scholarship and fellowship grant is going to be underlined non-taxable if the recipient is underlined degree students, to the extent the scholarship or fellowship grant is used for tuition and fees, books, supplies, equipment, but not room and board, which will be taxable. So, for all non-degree students, scholarships and fellowship grants received are taxable. But for degree students who use the scholarship and fellowship grant for tuition and fees, books, supplies, equipment, it's going to be non-taxable for them. Next, highlight tuition reductions. So for education below graduate level, tuition reductions are non-taxable to the recipient of the tuition reduction benefit. However, for graduate education, the tuition reductions are underlined non-taxable only if the tuition reduction is in addition to other taxable compensation received by the recipient. And just to connect these together, put a bracket from scholarships and fellowship grants down to tuition reductions. So guys, all of this is other income, or the O of Sir You O.
On the Form 1040, individual taxpayers are taxed on their worldwide income. I know you're thinking that when these US citizens, US residents earn money in foreign countries, they would have paid taxes in those foreign countries. And that is where they are allowed a foreign tax credit. So when I say ACE dear equals foreign business winner, the F foreign is foreign tax credit. So if they've paid taxes in a foreign country, that would be allowed as a foreign tax credit, a dollar for dollar reduction of their US taxes. Also, for Americans who've been living abroad for most of the year, they may be allowed to exclude over $100,000 of their foreign earnings from their gross income.
Back on page 47, towards the bottom, write W. So this is the W of Sir You O. And we know this stands for wages and salaries, which we have already covered in Reg 1.2, the first sub portion. Turn to page 48, where we've got earnings from foreign sources, and this one is E of Sir You O. Towards the bottom of the page, put a box around US citizen or a resident alien of the US living abroad. And all of them are taxed on their worldwide income. However, the taxpayer may qualify to exclude a certain amount of income of foreign earnings. This is if the taxpayer satisfies any one of the following tests. So draw a bracket and write there 100K plus exclusion if, so the exclusion is over $100,000 for the taxpayer if either one of the tests is met. The first one, highlight bona fide residence test, where the taxpayer has been a bona fide resident of the foreign country for an entire taxable year, or highlight physical presence test, where the taxpayer is present in the foreign country for 330 full days out of any 12 consecutive month period. Move to page 49 and highlight section 965 transition tax. This is applicable further to the Tax Cuts and Jobs Act, wherein highlight a one-time tax may be applicable for the taxpayers, which is calculated when filing highlight 2017 tax returns. And this may apply for put a box around US shareholders of any specified foreign corporation, which is a SFC, where the taxpayer may have to pay a one-time transition tax on the taxpayer's pro rata share of highlight the foreign corporations or the SFCs accumulated post 1986 deferred foreign income. Now, we're going to cover this in detail when we're doing Reg 3. So right there, cover in Reg 3. On the next bullet, put a box around US shareholder of a CFC, which is a controlled foreign corporation, where the taxpayer is highlight required to include GILTI or global intangible low taxed income in gross income annually. And we're going to talk about CFCs and GILTI when we get to Reg 3. So right there, cover in Reg 3.
We've spent a lot of time talking about all the income, all the gross income that's taxable on your Form 1040. So we looked at all the schedules, Schedule B, C, D, E, F, and our mnemonic Sir U O. Now let's take a moment, let's take a step back and talk about certain items of income which are non-taxable, which are not included on your 1040, which are not included on your gross income. And our mnemonic to summarize all those items would be AID. A-I-D. Think of it like a token aid from Uncle Sam to all taxpayers. Now, it's an aid because Uncle Sam does not tax this income. This is non-taxable income for you. Let's go one by one. Now, the A of aid stands for alimony received. So, think about a divorce arrangement where the husband and the wife are divorced. Now the husband needs to pay alimony to the ex-wife. So for the ex-wife, so think about the husband here and the wife out here. The husband is paying alimony to the ex-wife. For the ex-wife, it's alimony received or alimony income. Now for divorces which happen from 2019 and onwards, the alimony income of the ex-wife is non-taxable. But let me get back. Let me talk about the old rules first. So as per the old rules, when the husband was paying alimony to the ex-wife, for the ex-wife it was alimony received. It was taxable income for the ex-wife. She included the alimony received as part of gross income. The husband, poor husband, was paying out the dollars even after the marriage was called off. Paying the alimony. He was allowed a deduction and adjustment to AGI. The wife was getting money, alimony received, income. The husband was paying the money, alimony paid, a deductible expense. Now, this was the old rule. This is still applicable for divorces which had happened up till 31st December 2018. Now, of course, all the women, all the divorced women who are receiving the alimony, they weren't happy with Uncle Sam. They complained to him. They said, we're getting alimony from our ex-husband and we are having to pay taxes on that. And Uncle Sam finally got convinced. So all divorces which happened 2019 and onwards, Uncle Sam has given a clean check to these divorced women, the ex-wives, such a way that all the alimony received by these ex-wives now is non-taxable income. That's the A of 8. Let's talk about what's happening with the husbands. So the husbands, even 2019 and onwards, they are paying the alimony to the wife. Earlier, the husbands used to get a deductible expense for the alimony that they paid. But now, since the alimony is a non-taxable income for the wife, the husbands who are paying the alimony no longer get a deduction. So guys, not only do the husbands have to keep paying the alimony, they no longer get any deductible expense for that. So basically what's happening is, for the wives, it's good news. They're getting the alimony and they don't even have to pay taxes on them. For the husbands who are paying the alimony, it's like bad news. They have to pay the alimony and they don't even get a tax deduction for the alimony paid. So once again, old rules up till 2018, taxable income for the ex-wife, deductible expense for the husband. New rules 2019 and onwards, for the wife, non-taxable income. For the husband who's paying the alimony, a non-deductible expense. So as I told you, we're going to talk about token aid from Uncle Sam to all taxpayers. So A of 8 was alimony received. Alimony received, let's say, by the ex-wives who were getting alimony from the ex-husband after the divorce. The I of 8 is inheritances and gifts. Let's say you receive gifts from your grandmom, or you got $1 million inheritance from one of your Uncle Scrooge. You're super happy. And there's another bonus that you're going to get from Uncle Sam. This gift or this inheritance that you received is tax-free. It's non-taxable income. It does not get included on your gross income on your 1040. Now, when we get to Reg 4, I'm going to talk to you about gift and estate taxes, where I'll tell you the payer of the gifts, let's say your grandmom in this case, or the estate which pays out the inheritance, Uncle Scrooge's estate, would have to pay gift taxes and estate taxes. For the recipient of gifts and inheritance, it's tax-free, it's non-taxable income. And that's why it's the I of 8. The D of 8, and I said it's a token aid from Uncle Sam. The D of 8 here is distributions. Now, we spoke about a couple of distributions when we did non-taxable fringe benefits. Let's get there. So we said for non-taxable fringe benefits, life insurance, when the beneficiary of the life insurance receives the benefits or distributions, it is non-taxable. So let's say the deceased spouse is getting the life insurance benefits. Now, for the spouse of the deceased, these life insurance benefits or life insurance distributions are non-taxable income. Let's talk about medical insurance, or you could talk about accident health insurance, Medicare benefits, workmen compensation. All these come in times of difficulty. So you're going to get medical insurance when you get hurt, injured, hospitalized. So distributions from medical insurance are non-taxable. Distributions from workmen's compensation are non-taxable. And that is how we look at the aid, where the D of aid is distributions. So guys, once again, aid is non-taxable income which does not get included on your 1040.
On page 50, we're looking at a bunch of, put a box around non-taxable items. And our mnemonic for these few non-taxable items is aid. So think of it as a token aid from Uncle Sam for all taxpayers. The first one, right? A of aid is alimony received. Let's make a note out there, right? Divorces from 2019 and highlight from 2019. There's no tax impact for alimony. Which means that, right, if husband pays alimony to ex-wife, for the right ex-wife, it's non-taxable income, and highlight that. And because it is non-taxable income for the ex-wife, it is right non-deductible expense for the husband. However, the earlier rule, which still applies for right divorces up to 2018 and highlight up to 2018, right, for ex-wife, alimony received is taxable income, and highlight that. And because it used to be taxable income for the ex-wife, right, for the husband, alimony paid was a deductible expense. And right there, adjustment. The next non-taxable item out here, right? I for aid, which is inheritances and gifts, which are non-taxable to the recipient. And we're going to cover this in Reg 2.1. Move to page 51, where we've got D of our aid, which is distributions from, the first one out here is highlight life insurance proceeds. So life insurance proceeds are non-taxable if they are paid out on highlight death of the insured, or if there are accelerated death benefits received under a life insurance policy by highlight a chronically or terminally ill individual. Put a bracket around both these and write non-taxable if. Also, highlight dividends on unmatured insurance policies are non-taxable. Note that the following are underlined taxable. Underline interest on deferred payouts of life insurance proceeds. Circle or underline excess pro rata amounts received in case of payouts in installments. So for example, if the life insurance proceeds of $50,000 are paid in 20 equal annual installments of $3,000 to the beneficiary, the taxable interest, which is reported by the beneficiary on each installment, is $500. Also, it's going to be taxable if the life insurance proceeds are received in case of underline a policy obtained by the beneficiary from a person other than the insurance company. On the next sub-bullet, we're talking about distributions from highlight Medicare benefits, accident and health insurance benefits. workman compensation or an injury award. All these distributions are non-taxable for the taxpayer. However, underlying punitive damages are always taxable. So if the taxpayer is a recipient of punitive damage awards, that's taxable. Similarly, if the taxpayer is a recipient of any underlying non-physical injury awards like age, race, or sex discrimination, or injury to reputation awards, all these underlying are also taxable. Draw a bracket from punitive damages through the non-physical injury awards. Right there. Sir, you owe. And circle the O, because we know that if the taxpayer receives any punitive damage awards, or if the taxpayer has been a victim and receives any non-physical injury awards, all that is taxable as other income on 1040.